What if the biggest silver run of this cycle isn't hype at all, but a rare momentum breakout being flagged by a technician with decades of receipts? Michael Oliver, the founder of Momentum Structural Analysis, the man who called the 1987 crash, has gone on record saying silver hits $200 by Q2 2026. Quick one, if you want clear step-by-step breakdowns like this as the setup unfolds, hit subscribe and turn on the notification bell so you're first to see the next update when the signal shifts fast. He's been analyzing commodity markets for 4 decades, and he just dropped a statement that Wall Street is acting like it never happened. On December 16th, he told Palisade Gold Radio that silver will hit $200 by the second quarter of 2026. Not 10 years from now, not 5 years from now. Q2, April, May, June. Then January 12th, he went even further. He said, and I quote, "My minimum is $200, but I wouldn't be shocked if it approached $500. $500 per ounce." And as I'm recording this right now, silver just hit 88.15. That's not an all-time high, but the momentum Oliver pointed to is showing up in real time right in front of us. And when the interviewer asked him if it's too late to get in, his answer was crystal clear. It's not too late. He says the breakout is just beginning. In this emergency broadcast, I'm going to walk you through Michael Oliver's exact technical setup. I'm going to show you the momentum indicator he leans on, an indicator he says has never failed him over 40 years of work. I'm going to explain why he believes multi-month corrections are over and why pullbacks now last only days. And I'm going to reveal the one chart pattern he points to as proof the silver market has fundamentally changed. And listen, if you think you missed it, Michael Oliver is basically shouting the opposite. He's saying, you're early. This is the story of a technical breakout that could change everything. Michael Oliver is not a YouTuber. He's not a retail pumper. He's not selling coins. He spent decades at Lehman National Commodity Division in the 1970s and 80s. He studied under David Johnson, the chairman of the COMEX. He technically predicted and profited from the 1987 crash. In 1992, the Chobe Bank's Trust Department asked him to provide soft dollar research to Wachovia. Within a year, he shifted from brokerage work to full-time technical analysis. Momentum Structural Analysis is a firm that serves institutional investors. This is a man who traded with his own capital and has lived inside these markets longer than most of us have been alive. When Michael Oliver speaks, smart money pays attention, and right now, he's more bullish on silver than at any other point in his career. Here's what he told Palisades Gold Radio on December 15, 2025. He said the conversation takes an especially bullish turn when discussing silver. He predicts an extraordinary surge in silver prices, potentially reaching $200 by the second quarter, and he ties that target to proprietary momentum analysis. That detail matters. Oliver keeps drawing a line between price charts and momentum. Price can be shoved around. Price can be managed in the short term. But momentum measures the underlying strength of the trend. It's like checking the engine, not staring at the speedometer. You can mess with the speed reading for a moment. You can't fake horsepower without sustained force behind it. And as I'm recording this right now, silver just hit 88.15. That's not an all-time high. But the momentum Oliver pointed to is showing up in real time right in front of us. According to Oliver's system, silver just broke out of a multi-decade base. He says the breakout is comparable to what copper did in the 2000s. Copper spent about 20 years trading in a range, and then it exploded. It went from 0.60 to 4.50. That's roughly a 7 times move in less than 5 years. Michael Oliver believes silver is setting up for the same type of structural break, but faster. And here's the kicker. Just yesterday, January 12th, he went back on the record, this time on the Living Your Greatness podcast. And he upgraded the tone and the potential. He said, quote, "You don't get these multi-month corrections anymore. Now they're measured in days." Then he added, "Frankly, we expect to see silver reach. My minimum is like $200, but I wouldn't be shocked if it approached $500 to tell you the truth. $500. Let that sit for a second. This is the same framework that was in play when he technically predicted the 1987 crash. And now he's telling you silver is not a maybe story. He's framing it as structural. He's saying the market itself has changed. So let's break down what Michael Oliver is actually seeing, because the way he explains it is simple enough to follow, if you slow it down. His system doesn't look at price alone, it looks at momentum. Momentum is the rate of change. It's the force behind the move. You can slam price down with a few big sellers for a short window, but you can't fake momentum without sustained buying pressure from multiple sources over time. And right now, Oliver says the momentum in silver is breaking records. He uses something called a momentum oscillator. Think of it like a seismograph for markets. A seismograph doesn't wait for the earthquake to arrive. It catches tremors first. In Oliver's view, momentum is the tremor. Price is the headline that comes later. He points back to July 2020. In July 2020, silver's momentum oscillator broke a level it hadn't touched in decades. That was the signal. Back then, the price was still in the 20s, but the momentum was essentially saying, this is the beginning of something massive. Since then, momentum has not cooled off the way it used to. Oliver says you haven't seen a multi-month correction since the breakout began, and to him, that's unprecedented. In previous bull markets, silver often followed a stair-step pattern. It would rally, then pull back for months, then rally again, then another long pullback. That rhythm let people wait for the correction. That rhythm gave sideline money time to get comfortable. But Oliver's argument is that this cycle is different. This time, pullbacks are measured in days, not months. He gives examples to make that point concrete. When silver dropped from $35 to $30 in late 2024, a lot of people treated it like a panic event. Oliver called it noise. His focus wasn't the fear candle. His focus was whether the momentum broke. And he says momentum didn't break. Price recovered in 2 weeks. Then, when silver dipped from $65 to $60 in early 2025, it was the same story. People saw red, Oliver saw structure, momentum stayed strong, and price bounced back to $72. So what does he conclude from that? He concludes something critical about the buyers. He's basically saying these buyers aren't discretionary anymore. They're not casual speculators who disappear at the first sign of turbulence. He points to strategic buying forces, industrial users who need the metal, and sovereign wealth funds building strategic reserves. Those buyers don't care about a 10% dip. They treat dips like restocking windows. They buy the pullback. And when that keeps happening, it creates a force that lifts the market month after month. He ties that to a concept traders recognize: a rising support line. Oliver says the current support line is rock solid around $60, meaning even if there's a flash crash, the market may not live below $60 for long. In his framing, $60 is concrete. You can slap it for a day or two, but you can't live under it for months the way silver used to. Now let's talk about the gold to silver ratio. This is the number of ounces of silver it takes to buy 1 ounce of gold. Right now, he notes the ratio is around 70. Historically, the average ratio is closer to 50, and in precious metal bull markets, the ratio can collapse to 30 or even 20. Why does that matter? Because silver tends to move faster than gold. It's more volatile. It has more industrial demand in the mix. When capital floods into metals, silver often overreacts on the upside compared with gold. Michael Oliver has a chart that tracks the momentum of the gold to silver ratio itself, and he says that momentum just broke down. If momentum in the ratio breaks down, it implies the ratio is about to fall, meaning silver is about to outperform gold. Then he does the math in plain sight. If gold stays at $3,000 and the ratio drops to 30, silver goes to $100. If gold goes to $5,000 and the ratio drops to 30, silver goes to 166. If gold goes to $8,000, which Oliver also predicts, and the ratio drops to 20, silver goes to $400. That's not a vibes-based claim. That's arithmetic tied to historical behavior in bull markets. And Oliver's point is that the ratio always collapses in precious metal bull markets, especially when the momentum structure says the break is underway. Now, he doesn't just talk ratios. He supports the momentum breakout concept with historical commodity parallels. He points to lead in the mid-2000s. In 2007, lead was trading around $0.50 per pound, after being range-bound for decades. Then industrial demand surged. Lead broke out. Within about 18 months, it hit 1.75, roughly a 3.5x move. Oliver says his momentum system caught that breakout. He told clients it was the start of a multi-year bull market. And they made fortunes. He points to copper again in the early 2000s. Copper spent about 20 years between 0.60 and 1.20. Then it broke out around 2003. By 2011, it was around 4.50. Oliver says his system flagged it around 1 or 30. Early adopters made roughly 3 times. And even latecomers who bought at $2 still doubled. And the point he keeps coming back to is this: momentum breakouts in commodities can be explosive. And once they begin, they often don't stop until the supply situation is fixed. And then he makes a claim that turns this from bullish into structural. He says the supply situation in silver is not fixable, at least not quickly. He points to a structural deficit of 200 million ounces per year. He points to no new megamines coming online. He points to existing mines running out of high-grade ore. He points to recycling not being able to keep up. He frames it as a crisis that could take a decade to solve. And in that decade, the price has to ration demand. The only way to ration demand is to make the price so high that marginal users drop out. And Oliver says his models imply that rationing price is north of $200. But here's the part he says should terrify the shorts. He believes the stock market is about to crash. He predicts the S&P 500 could decline by 50%, not a mild 10% correction, a 50% crash. And he connects that to capital flow. When equities crack, capital looks for refuge, and in his view, that money will flood into real assets: gold, silver, commodities, land. He points to the 1970s as the template. Stocks went sideways for a decade. Gold went from $35 to $850. Silver went from $150 to $50. Michael Oliver believes we are entering a 1970s-style commodity supercycle, but with a twist, because unlike the 1970s, we now have solar panels, we now have electric vehicles, we now have AI data centers with massive electricity demand. Industrial demand for silver is much larger than it was then, and he argues supply is weaker today. So in his framing, demand is stronger, supply is tighter, and the momentum structure is already in breakout mode. That's why he says the storm could go Category 5. Now let's talk timeline, because Oliver does something most analysts avoid. He puts a date window on it. He says Q2 2026, April, May, June. Why does he think it can move that fast? He ties it to the way momentum accelerates after a multi-decade base breaks. It takes years to build a base. That's the slow energy build. Then the breakout happens, and the first leg up tends to be measured. Not crazy. He points to silver going from $12 to $30 in roughly 4 years. He treats that as leg one. Then he points to the consolidation period. Silver spent 2023 and early 2024 consolidating in the high 20s. In Oliver's language, that consolidation is building energy. And the longer the consolidation, the more violent the next leg can be. Now he says we're in leg two. Leg two is the acceleration phase. Silver moved from $30 to $65 in less than a year. And Oliver says leg two is just getting started. He mentions a historical tendency. Leg two is often 3 to 5 times the size of leg one. If leg one was $12 to $30, that's an $18 move. Multiply by 4, and you get $72. Add it to the $30 base, and you land around $102. But Oliver isn't hanging his $200 to $500 potential on that simple math. He's leaning on momentum divergence, on what the oscillator says about trend force, and he's saying the momentum structure allows for $200 as a minimum target, with $500 as a possible overshoot. And that brings us to the concept that scares people and makes people rich: the mania phase. In the mania phase, commodities overshoot. They go parabolic. He points to oil in 2008. Oil went from $70 to $147 in about 6 months, and then it crashed. But for that 6-month window, it defied gravity. He points to silver in 2011. Silver went from $18 to $49 in about 4 months, and then it crashed. But for those months, anyone holding silver looked like a genius. Oliver's view is that we are approaching the setup for a mania phase. And in a mania, price stops caring about fundamentals. It cares about one dominant force: fear of missing out. He paints the picture. When CNBC runs silver stories every night, when your neighbors ask how to buy it, when coin shops have... Now let's address the elephant in the room: the miners. Oliver isn't just bullish on silver, he's even more bullish on the silver miners. In the December interview, he said, massive surge for miners. He believes miners could double relative to gold, while also benefiting from rising silver prices. He explains it with simple margin math. If a miner produces silver at a cost of $20 per ounce, and silver is $30, they make $10 per ounce. If silver goes to $100, they make $80 per ounce. That's an 8 times increase in profit per ounce. Then he points out the stock market reality. Equity prices can move 3 to 5 times the profit change in a hot cycle. So an 8 times profit increase can translate into a 24 to 40 times stock price move. That's why he calls junior miners the highest risk, highest reward play. But he also warns, you must be selective. Not all miners are equal. Some are hedged, some are in dangerous jurisdictions, some have weak management. But the best ones, unhedged miners in safer countries, can become lottery tickets in a true bull phase. And he says the structural momentum is pointing to the sky for gold, silver, and especially junior miners. That especially is the roadmap to where the biggest upside could sit. He supports that with historical analogies. In past commodity bull markets, junior miners have outperformed the metal by 10 to 20 times. And he points to other booms where the best juniors went extreme. Uranium, $20 to $140, about 7 times. The best junior uranium miners went 50 times. Lithium, $6,000 per ton to $80,000, about 13 times. The best lithium miners went 100 times. Oliver's message is that the setup exists in silver now, and the clock is ticking. Now, risk, because nothing goes up in a straight line. Oliver admits there will be volatility. He He notes silver has seen sharp volatility recently, sliding about 16% from record highs, then rebounding back within about 10 sessions. That kind of drop is a gut punch if you're not mentally prepared. A 16% drop from $80 is roughly a $13 move from $80 to $67. If you bought at the top, you're suddenly down $13 per ounce. On a 1,000 ounce position, that's $13,000. Most people can't stomach that, and that's why they sell the bottom. Then price rips back to $82 and they chase again. They buy high, sell low, losing money in a bull market. This is why Oliver's point about pullbacks lasting only days is not a motivational slogan. It's a tactical warning. If you understand the structure, you don't panic on the drop, you hold. Or if you're built for it, you add on the dip. Weak hands get shaken out. Strong hands get richer. Oliver is basically telling you, be a strong hand. He's saying the buyers are strategic accumulators now, and strategic accumulators don't sell on 16% dips. They buy. So if you're going to participate, you have to accept volatility as part of the deal, and you need a time frame. If your time frame is Q2 2026, then a pullback in February is noise. If your time frame is I need profit this week, you're going to get chewed up. In Oliver's framing, commodity bull markets are not built for day traders. They reward people who see the big structure and hold through the turbulence. He's done this for 40 years. He lived through 1980. He lived through 2011. He knows what a real bull market looks like, and he's telling you this is the real deal. Now let's talk counter-argument. Skeptics say silver has already tripled. It's too late. It's overbought. Oliver addressed that directly. He said, why it's not too late for gold, $200 silver next year, and a massive surge for miners. That's literally the title of his December 16th interview. He knows people feel late, and he's explicitly saying they aren't. Why? Because in his framework, momentum peaks at tops. Right before a crash, momentum goes parabolic and then breaks. He's saying, we're not there yet. Momentum is strong, but not at the parabolic blow-off peak. So there's still room. He also points to gold. He says gold has broken out of a long-standing trading range, signaling the start of a potentially multi-year bull market. And in precious metal bull markets, silver usually outperforms gold. So if gold is in the early stage of a multi-year bull, silver is not done. Silver is likely early as well. He tightens the logic. The only way he's wrong is if gold collapses back below $2,500. But he doesn't see that. He sees gold going to $8,000. And if gold goes to $8,000, then silver at $200 minimum is not extreme in his model. It's consistent. Here's the setup for the next few months as Oliver frames it. We're early in leg 2, the acceleration phase. Price moves faster, corrections get shorter, volume increases, media coverage increases, and at some point the public wakes up. When the public wakes up, you enter leg 3, the mania. That's when silver can go from $100 to $200 in weeks. That's when the mainstream can't ignore it. That's when your Uber driver asks about silver, and that's also when Oliver would likely tell you it's time to take profits, because that's when momentum peaks and then starts to break. But he's saying we're not there yet. We're in early leg 2. Institutions are positioning, professional money is participating. The retail public is still mostly asleep. So in his words, you're not late, you're early. So what should you do? Michael Oliver isn't giving financial advice. He's giving technical analysis. But his analysis implies a clear path. Number 1, if you don't own physical silver, start buying. Don't try to time the bottom. Dollar cost averaging. Buy some now. Buy more on dips. Build a position over the next 30 to 60 days. Number 2, if you're more aggressive, look at the miners. Focus on unhedged producers in safer jurisdictions, Canada, the USA, and Australia. Avoid Mexico and Peru unless you understand the political risk. Junior miners can offer more upside, but also more downside. If you can't handle a 50% pullback, stick to the majors. Number 3, set a time frame. If you're targeting Q2 2026, that's 4 to 6 months. Don't check the price every day. Don't melt down on red days. Trust the momentum structure. And number 4, have an exit plan. Oliver's edge is spotting when momentum peaks and starts to break down. When he says momentum is rolling over, that's the signal. Don't get greedy. Don't hold for $500 if he's warning the top is in around $220. Take profits. Rotate into other assets or rotate into gold, which is typically more stable. The goal isn't catching the exact top. The goal is riding the trend and stepping aside before the crash. Michael Oliver is your guide in this story. Listen to him. We are living through a historic market event. Michael Oliver, the man who called the 1987 crash, the man who has studied commodity cycles for 4 decades, is telling you silver is set up to explode. He gave you a timeline, Q2 2026. He gave targets, $200 minimum, $500 possible. He told you it's not too late. He says the breakout is just beginning. He says momentum has never been stronger. He says the structure has changed. He says multi-month corrections are over. He says pullbacks last only days. He says the buyers are strategic accumulators, industrial users, and sovereign wealth funds. They don't sell dips, they buy them. And that creates a floor that rises month by month. He says the gold to silver ratio is breaking down. He says miners are about to surge. He says the stock market is vulnerable to a major decline. And he says capital will likely flood into real assets. This is the setup of a lifetime, if he's right, and his track record is why people listen. You have two choices. You can listen to mainstream media telling you silver is a bubble, or you can listen to Michael Oliver, a technician with decades of work behind him, who's calling for a structural breakout. The choice is yours. The clock is ticking. Q2 2026 is close. If Oliver's right, silver could be at $200 by June. That's roughly 2.3 times from here. And if the overshoot happens, $500 is a different universe, about 5.7 times from $88. This is not financial advice. This is technical analysis from one of the most respected voices in this space. Do your own research. Make your own decisions. But don't say you weren't warned. Michael Oliver just gave you a roadmap. The question is, are you going to follow it? Let me know in the comments below. If pullbacks really are measured in days now, what would it take for you to stop waiting for the perfect dip and start acting on the breakout?